31%. That's how far silver futures dropped in one day, right after the market had convinced itself that metals only move in one direction. Gold didn't merely wobble, it fell 11% in the same session, after briefly pushing above the psychological line of $5,000 an ounce. Then the selling rolled into the next trading day anyway. On Monday, February 6, 2026, gold sank as much as 8% intraday to about $4,165 before rebounding toward $4,700, still down on the day. 60 an ounce after the prior day's collapse, not months, not weeks. And the reason this matters isn't because prices fell, markets fall. The reason it matters is because of how it fell, who was forced to act, and what changed inside the system right in the middle of the move. Because when a market drops in a clean, orderly way, it's usually a change in opinion. When a market drops in a vertical, chaotic way, it's usually a change in collateral. And collateral is where institutions live. They don't start with the narrative. They start with the plumbing, margin, liquidity, and the hidden leverage sitting behind every confident headline. Here's what most people miss. The metals market didn't just crash. It revealed its hand. It showed you in public who was overleveraged, where the exits were too small, and how quickly the rules can tighten when volatility becomes a threat to the clearing system. And that's not conspiracy, that's structure. And once you understand structure, the last 48 hours stop looking random and start looking like the opening move of a familiar playbook. Welcome to Channel Name, where we decode what matters before it becomes consensus. If you've ever felt like the real explanation arrives after the move, you're in the right place. Think of this channel like that calm, well-informed elder who doesn't shout, but always seems to notice what the room is ignoring. If this helps you connect dots, stay close, and drop a comment with where you're watching from, because this metal story is global. Now, let's reconstruct what happened with forensic detail, the way the tape experienced it. Precious metals had been in a powerful uptrend through 2025 and into early 2026. Gold was up more than 60% in 2025, and it extended those gains into the opening weeks of 2026, running beyond what most forecasting models had projected. Silver was even more extreme. After rising about 170% in 2025, it added another sharp leg higher early in 2026, and at the peak, traded around $121 per ounce before the air came out. As the run accelerated, the conversation shifted. That is always the moment to pay attention, not because the move must end immediately, but because the market's fuel changes. Early buyers are motivated by thesis. Late buyers are motivated by fear of missing out. And fear of missing out is the most leverage-friendly emotion there is. By late January, the metals trade had become crowded. Futures were hot. Options activity was intense. Leveraged products attracted flows. Reports described especially heavy speculative demand in China, where local pricing and precious metals ran above international benchmarks. When that happens, it's telling you something important. Either the physical market is tight, or the system has enough friction that normal arbitrage can't instantly close the gap. In calm times, gaps like that disappear quickly. In stress times, they persist because the friction isn't information, it's access, financing, and settlement. Then the catalyst hit. News and reporting circulated that President Donald Trump would nominate Kevin Warsh as the next chair of the Federal Reserve. Markets interpreted it as a shift toward a more hawkish, more inflation-focused posture, and at the same time as a reduction in immediate fears about Federal Reserve independence. The US dollar strengthened and rate expectations adjusted. In a balanced market, that would have been a headline, a pullback, and a reset. In an overcrowded market, it became a trapdoor. Crowded trades don't unwind politely, they unwind in waves. The first sellers are the fast money that got in late. The next wave is the leveraged money that can't tolerate volatility. The final wave is the forced sellers, the ones who aren't making a choice at all because the system is making it for them. Friday's move was the signature of forced selling. Silver futures plunged 31% in a single day. Gold fell 11%. Those are not normal moves for these markets. For gold, a 1% day is already noteworthy, an 11% day is a structural event. It's the kind of move that breaks risk limits, triggers margin calls, and forces position reductions across portfolios that have nothing to do with the original thesis. And then, right into that volatility, the rules tightened. The CME, which sits at the center of futures trading infrastructure for many of these contracts, raised margin requirements. 8% for heightened risk profiles, 5% for heightened risk. The exchange had also shifted toward percentage-based margining in early 2026, which meant the collateral demands could expand quickly as the underlying price moved. If those numbers sound like paperwork, translate them into behavior. A standard COMEX gold futures contract represents 100 troy ounces. A silver futures contract represents 5,000 ounces. Futures are designed to be leveraged, which is why they're powerful and why they're dangerous in volatility. That doesn't just discourage new entrants, It forces existing participants to post more collateral immediately or reduce exposure. Imagine a trader controlling a $1,000 futures position. At a 6% margin requirement, they might need $60,000 posted. At 8%, they need $80,000. That $20,000 difference doesn't come from optimism, it comes from cash. If the cash isn't available, the position shrinks. Multiply that dynamic across thousands of accounts, across brokers, across funds, and you get mechanical selling that overwhelms the market's ability to absorb it. This is where the market reveals its hand. Price becomes secondary. Cash becomes primary. On Monday, February 2nd, 2026, you saw the aftershocks. Gold still fell intraday to around $4,465 before rebounding toward $4,700. $60 alerts still reeling. And other metals that had been running hot began to wobble too. 583. On that same day, copper futures volume surged to roughly 245 hours, 464 contracts, a level that signals unusually intense participation. It's an industrial lifeline. When copper is making records while gold and silver are making records, it suggests the broader commodity complex is in a momentum regime. Momentum regimes feel like fundamentals until they don't. They end when positioning becomes too crowded, when liquidity becomes too thin, or when financing becomes too expensive. So here's the central mystery that shook people. If gold was a safe haven, why did it fall on a headline about central bank leadership? And if silver was supposedly being driven by long-term industrial demand, why did it collapse like a leveraged growth stock? The answer is that in stress events, the market doesn't price narratives first. It prices balance sheets first. The safe haven story can be true over years while still failing over days. That's the difference. In a liquidity crunch, assets don't trade on identity. They trade on liquidity. Gold is liquid. Silver is liquid. They are among the first things that can be sold to raise cash. That is why even the assets people buy for safety can become the assets they sell for survival. Now let's zoom out, because this is not the first time the metals market has used this exact script. In 1980, silver experienced one of the most famous blow-offs in commodity history. The details differ, the participants differ, and the world's macro backdrop was different, but the ending rhyme is unmistakable. Speculation grew, leverage built, volatility increased, rules tightened, margins rose, liquidity vanished, and the unwind was brutal. In 2011, silver ran again, powered by post-crisis fear, monetary stimulus, and the belief that hard assets were the only refuge. The public explanation was emotional, the structural explanation was mechanical. As volatility surged, margin requirements were increased multiple times in a short span. The price snapped lower. That was the market recalculating what leverage could survive. Then 2020 added another chapter. In the early pandemic shock, liquidity dried up everywhere. Even assets that were supposed to hedge fear sold off at times because large players needed cash to meet obligations elsewhere. When portfolios are stressed, correlations compress. Everything becomes one trade. Raise cash. That's why, in the most intense moments, diversification can fail temporarily. It doesn't fail forever. It fails when cash is scarce. Now bring that history into 2026. You have a parabolic run. You have a catalyst that changes dollar strength and rate expectations. You have volatility that overwhelms normal risk models. And then you have margin hikes that raise the cost of holding the position. Same arc, same structural fingerprint, different decade. But here's the contradiction that proves the market is two different worlds living on top of each other. While the leveraged crowd was being forced out, the slowest, most deliberate buyer in the world was still quietly accumulating. 3 tons of gold in 2025. In the fourth quarter alone, net purchases were about 230 tons, a 6% increase from the prior quarter. And the National Bank of Poland added 102 tons in 2025, making it the largest reported buyer for the second consecutive year. At the same time, investment demand was exploding. Reports put total investment demand for gold at about 2,175 tons in 2025, up roughly 84% year over year, with strong flows into gold-backed ETFs and increased interest in bars. So you have a market where official buyers moderated from prior peaks, yet still bought at historically elevated levels, while private investment demand surged. That is a market with 2 bids operating on 2 different clocks. That's why you can see a crash and still hear bullish forecasts from major banks. In the middle of the panic, some analysts were still talking about gold potentially moving towards $6,000 later in 2026. The contradiction isn't that analysts are confused. The contradiction is that 2 time horizons can both be true. Long horizon demand can remain intact, while short horizon leverage gets destroyed. Now, let's name the players, because this story becomes clearer when you stop thinking in abstractions. Start with the exchanges. The CME sets the collateral rules for COMEX futures, and those rules are designed to protect the clearinghouse. The clearinghouse exists to ensure trades settle even when one party fails. When volatility spikes, the clearinghouse demands more protection, and the exchange implements that protection through margin. In parallel, reporting described margin requirements increasing at key venues in Asia, including the Shanghai Gold Exchange, as volatility surged and speculative participation intensified. At the same time, Chinese banks tightened trading restrictions and suspended certain metals funds, limiting new subscriptions or closing pathways that had previously allowed easy leverage. That matters because when access tightens in one region, while futures are collapsing in another, you're not watching a single market. You're watching multiple systems tightening at once. Next, consider the brokers and clearing members. They sit between the exchange and the trader. When margin requirements rise, brokers issue margin calls. Those calls are not philosophical. They are deadlines. If a trader can't post more cash, the broker reduces the position. It's automatic. And in a fast market, that automatic selling can happen into a vacuum. Then there are the dealers and market makers in options and ETFs. When volatility explodes, option prices jump. Dealers who sold options to customers may suddenly be short gamma, meaning they must hedge more aggressively as price moves. That hedging can accelerate moves in futures, which raises volatility, which raises margin, which forces more selling. It's a feedback loop. And feedback loops are why markets can move farther than fundamentals would justify in either direction. Finally, there are the long horizon holders, central banks, some sovereign funds, and institutions that treat gold as a reserve asset rather than a trade. Their behavior doesn't change because of a two-day crash. It changes because of policy, currency risk, and multi-year strategy. They don't provide a bid on the same timeline as a panicked futures account, but they are always part of the background. They are the quiet demand that can make a crash look very different once the leverage has been cleared. Now the dislocation. This is the part no one can ignore once they see it. There are at least 3 dislocations that showed up during this episode. The first is paper versus physical. Paper markets like futures and options can trade enormous notional volume without a single bar moving. Physical markets are constrained by inventory, vaulting, financing, and transport. In a mania, paper can outrun physical because leverage can create more demand than the physical market can express. In a panic, paper can crash faster than physical can adjust because paper positions can be liquidated instantly. That's why you can see a futures collapse at the same time that local premiums remain elevated, and why the physical conversation can stay tense even as the paper chart looks like a disaster. The second dislocation is east versus west. When speculative intensity concentrates in one region, local pricing can detach from global benchmarks. Reports described a premium in China's local silver pricing, and even cases of smuggling when that premium grew large enough to make arbitrage profitable. Smuggling isn't a cute anecdote. It's a signal that the normal channels of supply and pricing aren't flowing smoothly. In response, restrictions tighten. That can keep local prices elevated even while global futures are falling, because the local constraint is not just price, it's participation and access. The third dislocation is headline versus structure. Headlines said metals were surging because of geopolitical tension and fears around the Federal Reserve. Structure said the trade was overcrowded and leveraged, and that a shift in dollar strength could detonate forced liquidation. When those collide, structure wins first. Headlines are how people explain what structure already did. Now, the evidence with numbers, because this is not opinion. 60 on February 2, after having touched around $121 at the peak. Gold fell 11% in the crash, and then dropped intraday to about $4,165 on February 2, before rebounding. Those are forced liquidation signatures. Then margin, 8% for heightened risk, 5% for heightened risk. That is a direct increase in the cost of holding the trade. It's a liquidity tax, and it arrives when liquidity is already strained. Then positioning heat in related metals, 583 and volume around 245,464 contracts. That kind of participation is not quiet hedging. That is a market running hot. Then the slow horizon bid, 3 tons of gold in 2025, including 230 tons in Q4 and Poland adding 102 tons. Even if official purchases moderated from the prior years, those volumes remain well above long-term historical averages. That tells you the long-term demand base is real. The short-term price shock is about leverage and liquidity, not the disappearance of every long-term motive. Now let's make the mechanism simple without dumbing it down. Think of leverage like building height on a foundation. If the foundation stays stable, you can build high. If the foundation starts shaking, every extra story becomes a liability. Margin is the rule that determines how tall you're allowed to build. When volatility rises, the exchange lowers the allowed height by raising the required collateral. That forces the tallest, most fragile structures to come down first. In practice, it happens in a chain. Price drops, volatility rises, risk systems tighten, margin requirements increase. Brokers issue margin calls. Some accounts post cash, some can't. Those accounts are reduced. Selling pushes price lower. Lower prices trigger more margin calls. Dealers hedge options. Liquidity thins. Spreads widen. The tape becomes violent. And once the tape is violent, headlines pile on, which changes sentiment, which adds discretionary selling on top of forced selling. This is why the move felt like it came out of nowhere. The headline was the spark, but the accelerant was the structure. And the structure was primed because the trade was crowded. So what does this mean, forward, in the language of pattern rather than prediction? Historically, after a parabolic move breaks and margin rises into volatility, three broad paths tend to appear. The conservative path is stabilization through time. Volatility cools, participation normalizes. The market spends weeks building a base as leverage is reduced and confidence resets. In that scenario, the most important signal is whether panic volume declines and whether margins remain elevated or start easing. Stability is often visible in the plumbing before it's visible in price. The moderate path is a second wave of liquidation. That happens when the first break forces some selling, but not enough to fully clear the leverage. The market bounces, people declare the bottom, and then another sharp downdraft appears as remaining leverage positions are flushed. In that scenario, watch for additional margin adjustments, renewed restrictions in leverage products, and sudden widening in bid-ask spreads. The aggressive path is rotation. Instead of a straight line collapse, the commodity complex reshuffles. Precious metals stabilize while industrial metals absorb the macro narrative, or the reverse, depending on currency, strength, rates, and growth expectations. A stronger dollar can pressure commodities broadly, but structural demand stories, especially in copper, can reassert themselves after speculative froth is reduced. In that scenario, the key is whether demand indicators remain firm while volatility gradually compresses back toward normal ranges. What should be watched, specifically, if the goal is to understand rather than react? Watch exchange margin schedules because they reveal what the system believes about risk. Watch dollar strength and real rate expectations because they shape the financing environment for commodities. Watch physical premiums and restrictions in major demand centers because they reveal whether real-world demand is colliding with frictions. Watch volatility because volatility is the tax the market pays when leverage was mispriced. Now the divide. This moment separates two groups, and it has nothing to do with being smarter. It has to do with what is being watched. One group watches price and tries to infer everything from the last candle. The other watches structure and understands that price is often the final symptom, not the first cause. The information gap becomes a wealth gap, not because anyone is evil, but because institutions operate on different inputs. Institutions move first here in a quiet way, not in the sense that they cause the move, but in the sense that they understand how cascades form. They know that when a trade is overcrowded, the exit is small. They know that when volatility spikes, margin rises. They know that when margin rises, weak holders sell. Retail often learns the sequence in reverse after the liquidation has already written the lesson onto the chart. So when I say the metals market revealed its hand, I mean it showed you the hierarchy. The exchange protects the clearinghouse. The clearinghouse demands collateral. The broker demands cash. The leveraged participant sells. The long horizon buyer waits. And only after all of that does the story get rewritten to make it sound inevitable. Markets don't whisper before they turn. They signal in mechanics. This is channel name, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you already know what to do. Because the question isn't whether volatility returns. The question is whether you recognize the signals early enough to understand what the market is really saying when it moves this fast.